Good evening, one and all. How are you all, students? How are
Good
things
evening, sir.
going on at your end?
Good evening, sir.
Good evening, Sanjay. How are you?
I'm good. How are you?
Great. Things going good at your end, beta?
Yes.
Excellent. Did you all see the GST Council meeting minutes yesterday?
Yes, I saw the highlights only.
WhatsApp highlights?
The reduction of tax,
Sorry?
reduction of tax rates.
Nini, so you saw it on WhatsApp
No, no,
messages or
no.
you actually read the press release?
Red.
That's good. See, develop that habit because now we are professionals. So it is very important. Okay, for something crisp, you can go through some WhatsApp message or forwards, but it should be always your habit that your first reading should be the actual document, right?
Yes. Right.
Great. Hello, Chitra. Sanjay, where are you from, beta?
I'm from Noida.
Noida.
Yes.
Okay. And Chitra, where are you from, beta?
Maharashtra,
I know Maharashtra, but where in Maharashtra?
Dombivli.
Oh, Mumbai.
Yes,
Great. I just hope that rains are not troubling you much.
not now, not now.
Acha. Great, 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 great. Chalo. So, students, let us go back to the details. But before that, if you have any questions, doubts, please ask me so that I'll first answer you. If something you have studied which is not understood, or if some earlier point you were revising, there was some difficulty in understanding, let us first discuss that and then we will proceed. Tell me.
That's okay.
No doubts?
No doubt.
Okay. ठीक है. So, in our first class in the previous week, we had discussed the concept of income, chargeability, and then we came to the main discussion of chargeability vis-a-vis capital receipt. And over there, we concluded that every capital receipt need not be capital gain because capital gain has its own rules for chargeability. And then we discussed this that capital gain is an exceptional head. Why? Firstly, because it is taxing an exceptional income, that is a capital receipt. And second, in every provision, whatever you study, you find besides the provision many exceptions. Plus, one interesting thing that I told you is that capital gain is the only head which has multiple charging sections. Until now, we have discussed few of them. The main charging section is 45.1, which requires two basic things to be satisfied, asset and transfer. Then we also studied in the previous class 45.1a, where there is a destruction of capital asset. Please understand, destruction of capital asset is not transfer because the definition of transfer does not cover destruction, right? Then we also studied 45.1b, the third charging section, which specifically dealt with taxability of ULIPs, which ULIPs, specified ULIPs, that is where per annum premium exceeds 2.5 lakhs. Then in the first class, we discussed about what is transfer, what transactions are not transfer. And in the previous class, we discussed about what is asset, what will be treated as asset, what are exceptions to asset. Then we discussed types of asset, short-term, long-term. And we discussed for determining short-term, long-term, you have to count the period of holding. How to count that and what are again the exceptions or special cases relating to that. In that, I gave you this golden rule, which I said why I'm calling this as golden rule because it will cover 30 plus provisions, out of which around 10 are already covered in this particular case only, which we covered last lecture. That is how to determine period of holding, where in the period of holding explanation, you found multiple entries and majority of the entries were following this rule. What is this rule? where you have got the asset in one of those ways, one of those modes, which we studied in the list of not transfer. So if the method by which you acquired the asset was not transfer, then this golden rule 1 applies. What does the rule says? The period of holding will be counted from the date of previous owner, or where the asset got converted from one asset to another. If you have received the asset in that fashion and this conversion of asset from one form to another was not transferred, then the period of holding of this current new asset will be counted from the date of previous asset. So this is what we discussed. Then we also discussed, or we started discussing, some special cases where we found that one of our conditions, that is year of chargeability, which is discussed in 45.1, says the year of chargeability will be the year of transfer. So 45.1 is your main charging section, which also says that capital gain would be taxed in the year of transfer. However, this rule has exceptions. We have studied 3 exceptions till now. Few more are yet to come. First is in case of destruction of asset, the year of chargeability is year of receipt of insurance. Similarly, in case of ULIPs, the year of receipt of money against ULIP is the year of chargeability. And then last special case where we concluded our previous class was where you are converting your capital asset into stock in trade. In that case, there are 2 incomes. One is the PGBP income, one is the capital gain income. Both are taxed together in the year of sale of SIT. That is the year in which actually the PGBP income triggers. In that year only you will tax the capital gain income as well. So this was the example which we discussed relating to conversion of capital asset into SIT. So all these things we discussed in the previous class. Now today we proceed with some more provisions in capital gains, some more special cases in capital gains. Now again, I come back to this sequence where we have to study this chapter by studying each of the aspects. First is capital asset we did, transfer we did, section 10 exemptions we will deal with as we go to different scenarios. Then year of chargeability we have been dealing with. We have already identified the main provision and the exceptions. Now today we start with the computation part. Now computation requires these figures: full value, expenses on transfer, cost of acquisition, cost of improvement, and then indexing it if it is long term. So today we will try to explore these provisions so that we get now some perspective about the working part of capital gain. And along with this, again, we'll be exploring few special cases, some exceptional transactions, some new charging sections. So parallelly, these things will happen. I hope this flow of studying the chapter is comfortable with all. All are getting the grip of the subject. Anybody has any problem with this approach, you can tell me. But this is the best approach to study capital gains, so that you deal with provisions also, and at the same time, you also deal with some special case scenarios also. Like in the previous class, we studied 3 special case scenarios. One was insurance claim, one was your specified ULIPs, and the third one was the conversion of capital asset into stock in trade. So those were 3 special case scenarios. So we are studying both provisions also and some special case scenarios also. Fine?
Fine.
Perfect. Okay. Now, today, we start with the computation part first. And for that, we need to go to section 48. Again, I'm more keen on giving you the Bare Act. So let me take you to the Bare Act. What happened? Yes. Now, we all know section 45 is your charging section, right? However, how to compute capital gains is what is given in 48. So 45 is charging. 46 basically covered what is not transfer, one of the cases. and 47 covered all other cases what is not transfer. This is basically 46 and 47, though there are some few more things that we'll deal with as we proceed. And then comes 48, which deals with the, as you can see, the heading mode of computation. Correct? Now we'll study something from the Bare Act first so that you'll understand how the provisions are designed. So first understand 45 charging section. Once you cross the charging section, you come to the computation, but for crossing charging section, there is a list of not transfer. One scenario is covered in 46.1, which is company to shareholder in the case of liquidation, which is not transfer. And the second scenario, or not second, all other scenarios are covered in 47. So that is how the law is designed. So 46, 47 are dealing with what is not transfer and some special case scenarios that we'll study parallelly. And then comes 48, which says that once you come to the conclusion that your case is taxable under capital gain, how to compute the capital gain, that is what is covered in 48. Now, just for the purpose of, like I always am of the approach that as a student of finals, you should have the habit of reading the Bare Act. So we'll take the Bare Act first just for our understanding, and then we'll go to the module. Today, who will help me with the reading, please? Students, who will help me with the reading, please? Chitra, Sanjay, Neha. Who of you will help me with reading today?
So I will do it.
Please, Sanjay, thank you.
Yeah, welcome.
You can start with section 48.
Yes, section 48. The income chargeable under the head capital gains shall be computed by deducting from the full value of consideration received or accruing as a result of the transfer of the capital asset of the following amounts, namely expenditure incurred wholly and exclusively in connection with such transfer. Clause 2, the cost of acquisition of the asset and the cost of any improvement thereto.
Okay, okay, 1 second. So what does 48 says? It is dealing with the method of computing capital gains. And this is how, I'm sure at inter level, when you all studied the computation, you studied this format. I'm just putting down the format here. One, we write the year in which it is taxable, because as we saw, the year of chargeability is also an important aspect. And then the format is very simple. FVC minus expenses on transfer. This is what we call as net consideration minus cost of acquisition minus cost of improvement. And if the asset is long term, this will be index cost of acquisition or index cost of improvement. And then the resultant figure would be either long-term capital gain, capital loss, or it would be short-term capital gain, capital loss. Now, this is the brief format. And then once there is a capital gain, you are allowed to reinvest that and get some relief under 54. So once you deduct that, as per whatever 54, it is applicable 54, 54B, D, DA, etc. The balance is your taxable long-term, short-term capital gain. This is how the whole format is. Now, this format is as per section 48. So what is 48 saying? 48 says that wherever your income is taxable under the CG head, that computation has to be done as per this format. How? By deducting all these things from your full value of consideration. Now, interestingly, 48 also defines what is full value of consideration. It defines full value of consideration saying full value of consideration which is received or receivable as a result of transfer of capital asset. So full value of consideration is nothing but whatever you have received or you will be receiving, because it is accruing to you, and the reason for this consideration is the result of transfer. So it is the consideration against the transfer of that capital asset. Fine. Now, What are you going to adjust from it? One, the expenses which are incurred wholly exclusively in connection with the transfer, and the cost of acquisition or the cost of improvement, or both. So these things have to be deducted, and after deducting this, what you will be left with is your capital gains, loss, etc. I hope this is clear.
Yes, clear.
Correct. Now, as you can see, now this I had mentioned to you, whatever you study in this chapter, there will be exception. So as you can see, the moment you study this, there is a proviso which is creating an exception. And then when you complete the whole section, there are further multiple provisos. See, not one. There are multiple provisos to entire section 48. So this proviso is with respect to cost of acquisition and improvement point. But then you have multiple provisos which are creating exception to this whole format, which is given in section 48 itself. So this is how this chapter I mentioned in the first class itself is exceptional, because whatever you study, you have to counter some exceptions. Now with this backdrop, let me take you to the module. So we keep the act open parallelly. So wherever I feel, we'll go back to the act, but let us come to the module. Same thing is copied here. It shall be computed after deducting the following from full value. And we have this. Now, whatever you saw the exceptions over there, they are again repeated here, but in a simplified format. So we will study it from here just for the sake of our understanding. Now, out of this, few points may not be understandable to you. Why? Because the details of that will come ahead once we proceed with this chapter. So if that is the case, I will drop that point. Whatever I feel is digestible to you all, we'll discuss that now, or else we will proceed. So you can start with from here, Sanjay.
Yeah. However, the cost of acquisition of the asset or the cost of improvement thereto would not include the deductions claimed in respect of interest under section 24B or under the provisions of chapter 6A.
Okay. Now, let me link this with, I'm sure you all would remember what is this. This
Yes.
is, yeah. Can you tell me then, Beta, what is this?
Yeah, interest on borrowed capital.
Perfect. So whenever you are computing income from which head?
Income from house property.
Correct. So the one of the deductions, which is under clause B of section 24, allows you to claim deduction of interest. So where you have borrowed some money for acquiring that property, that house property, then the interest that you are paying, or the interest that is what is being accruing for that financial year, that can be claimed as deduction. Now what they have clarified, that whatever cost of acquisition we are talking about, that will not include the interest, but which interest for which you have already claimed the deduction. It means if something is not claimed as deduction, then that interest can be included here. See the other way of this reading this. So it is saying interest will not be included. Okay. But the other way of reading this is, it is a conditional point where it says that where the deduction of that interest is claimed under 24. If it is claimed, then it is not includable. Further, it says, or under the provisions of chapter 6A. Now, where under chapter 6A you have interest deduction, students? If you can recall and help me.
Interest
Anybody
on
can recall?
education loan. Interest on education loan.
You're right. But I don't think they'll be talking about that, because it cannot become part of cost of acquisition. See, we are studying one of the provisos relating to cost of acquisition and improvement, right?
Yes, yes. Yeah, of course.
But you are on correct lines. So you may just explore further. Everybody can explore further. You will definitely get the answer. Sorry. Just
there is deduction of the house loan in under section 80. I don't remember exactly section 80.
It is, if you are talking about the principal amount, it is 80C.
No. Yeah, one is 80C.
But
There
again,
are two other sections also.
Correct. Now you are on the right lines. Neha has put something in chat.
That is, yes.
No, Neha, Chitra, you both are talking about principal. We are talking about interest. But you're right, you're very close, and you rightly mentioned there are two sections.
There is one affordable housing. I don't exactly remember the section, 80 something.
No problem. You tell the content. Section number is okay.
If the loan is taken up to 50 lakhs and there is
Very
interest,
good. Is it double
which is
E,
deductible.
80 double EA, something like
Yeah,
this,
yes,
right?
80 Yeah, right, yes.
Correct? And there are two
Correct, correct.
sections, as you rightly pointed
Two
out,
section,
because
yes.
it was depending upon when the loan is sanctioned, right? If the loan
Yeah,
is sanctioned
yes.
somewhere in 1920, that financial year, the double E section was there. And later on, somewhere from 21 to 23 something or 24 something, the double EA section was there.
Yes.
You're right.
Yeah.
Now, if you have claimed the interest as deduction under one of these scenarios, 24B or Chapter 680 EEA, obviously it cannot be part of cost. But other than this, what is not claimed here can be part of cost. Now I'll tell you how. Go back to accounts. And the same thing you will also find in income tax in the chapter of PGBP, cost of acquisition of depreciable asset. Both are parallel, and this is the third where it is getting parallel. All these three provisions say what? I'll explain you from the point of view of accounts. In accounts, accounting standard 16 borrowing cost plus accounting standard 10 PPE. Both of these standards say that wherever you have taken a loan for construction of any asset, until the asset is ready, the asset is put to use, whatever is the interest, that interest has to be capitalized. Capitalized means it becomes part of cost. The same thing is there in accounting standards. The same thing is there in PGBP. So when you compute depreciation under section 32, for that you have to find out the cost of the asset, and the cost of the asset is as per section 43(1) read with different explanations. Over there, this point has been specified that the cost of asset will include interest up to the date the asset is put to use. Same point is reiterated here, because again here also we are talking about cost of acquisition of the asset, and they are saying the interest which is already not claimed as deduction, because obviously income tax will not allow you deduction twice. Now if you recall 24B, there is something called as pre-construction interest deduction which you claim 1/5. Try to recall, students. I hope you all are able to
Yes.
connect. Huh?
Yes.
At,
It is
at final
deductible
level,
in
students, it
fifth.
is very important that we read across the act and not one chapter. Yes, Sanjay, you are saying something.
Yeah, it is deductible in 5 installments. Pre-acquisition interest. Yes.
Perfect. And that is what is capitalizable, because that is before the construction is complete. That is why they
Yeah.
have said
Yes.
that either you are capitalize, I will allow you as cost. Even in depreciation, they say 43(1) says the same thing. If you have not claimed the deduction anywhere else, then you can take it as cost and you'll get depreciation. Same thing is given over here. So whatever interest is there, you capitalize, will allow you it as cost. But if something is already claimed by you under 24B, because it was dealing with your house and you had claimed the deduction there, then logically I cannot give you deduction twice, because capitalizing here will mean it will go to reduce the full value of consideration and ultimately reduce your capital gain. So I cannot give you deduction of the same amount twice. Perfect.
Right.
Yes, you can now proceed to the second point.
Yeah, deduction from cost of acquisition of a unit of a business trust. The cost of acquisition of a unit of a business trust has to be reduced by any sum received by a unit holder from the business trust with respect to such unit which is not in the nature of interest and dividend referred to in section 1023 FC or rental income referred to in section 1023 FCA, and which is not chargeable to tax in the hands of unit holders under section 56 to 12 and in the hands of business trust under section 115 UA2.
Okay. Now, what are these
However,
sections? Maybe this is not understandable, but no problem. In at final level, you have separate chapters for each of these, like dealing with taxation of business trust. You'll have a separate chapter. But for simplicity, just to give you an Acha, anybody knows what is a business trust by chance? Yes, anybody knows what is a business trust?
not exactly, no.
Nobody has dealt with business trust concept. Theoretically, I'm asking, not practically. Okay. Somebody saying something?
Yeah, sir. My organization had done the work of freedom from hunger for trust. Trust organized for hunger people. Like they had a
Explain
project.
further. Hmm.
Yeah, like they had a project for the villagers and how to immunize and how to uh, matlab, poverty like something do they
Nee,
did the
so
work.
was it a business trust?
I don't know any difference between business trust or normal trust.
Yes. What you are saying is correct, but that is a normal trust. See,
Okay.
chalo, I'll not get into much details right now because for that I have to explain many other things, but it is for the timing like a mutual fund. ठीक है, business trust is like a mutual fund created as a trust. That is why the name is business trust. But that trust is, let us say, going to like how mutual fund does. It collects money from us and it invests in different investment options. This will, let us say, invest in some business related options. That is why it is a business trust. So where, let us say, I cannot myself engage into business, I will invest money in a business trust, and that business trust will be investing in different businesses. Now you have similar models in different formats, like we say business trust, we say venture capital fund. So these are different ways how you actually do that work, but without actually investing it indirectly. See, one is I start that business myself, but that may be too risky. Then I require huge capital. I'm not capable of that. So instead, I make a mutual fund type of a thing, like a business trust, where me and you all are unit holders. So we all are like partners, unit holders. Same like mutual fund, we will invest our money, and the mutual fund over here, that is a business trust, against our investment will give us the units. So let us say it is a 10 rupee unit, and if I want to invest 10 lakhs, I will give them 10 lakhs, they will give me 1 lakh units. And my money is further invested by them in different earning opportunities. Right now, against this 10 lakhs, what I've invested, what should I get? I should get regular returns. Now, these returns could be in the nature of interest, dividend, rental income, because this is how the business trust deals with my money. They invested in some income earning opportunities in real estates, etc., from where I will be getting rental incomes, or in some other income bearing bonds, investments from where I'll get interest dividends. Now, when I get this from my business trust, that is my pure income coming from business trust. So that is a different thing. But many times the business trust may return me back the capital portion also. Now, what does this point says? Deduction from cost of acquisition of a unit of business trust. So I have purchased these 1 lakh units for, let us say, 10 lakh rupees. And over a period, besides these incomes or these amounts which are returned by business trust to me, which are in the nature of income, besides these, there are some capital repayments. So whatever is the capital repayment, they say that will be deducted from cost of acquisition, and that is logical. So it is like you invested some money and now the company is reducing the capital, so returning back your capital amount. Same thing over here. So if they are returning back you some portion, then that amount will be reduced from your cost of acquisition, so that now the units are same, but the cost of acquisition has reduced. Why? Because some premium portion was returned back. So this is what they are saying shall be reduced from the cost of acquisition. However, where transaction of transfer of a unit is not considered as transferred under 47 and cost of acquisition of such unit is determined under 49, some receipt in respect of such unit before such transaction as well as after such transaction has to be reduced from cost of acquisition. That is fine. So whatever is received towards the capital portion, that has to be reduced. Similarly, clause C is again dealing with one special case scenario, that is section 45.4. We will study that separately. So again, I'm not touching it over here because unnecessary. That can be confusing right now. So we'll deal with few of these when we proceed. Now coming to the first important point. Now in our format of 48, the first deduction that is allowed is of expenses on transfer. In very simple words, what is expenses on transfer? Expenses on transfer is, let us say I want to sell my property. So I put a paper ad, or I appoint an agent who gets me the buyer and I pay some commission to the agent. Now, these are the expenses which are incurred wholly, exclusively for effecting the transfer. That is the expenses on transfer. And that is the first thing that is to be deducted from full value of consideration while computing capital gain. Now again, it has an exception that one expense cannot be deducted. Please read this point.
Yeah. No deduction in respect of securities transaction tax paid. No deduction, however, shall be allowed in computing the income chargeable under the head capital gains in respect of any amount paid on account of securities transaction tax under Chapter 7 of the Finance Number 2 Act 2004.
Anybody knows what is a securities transaction tax? Can anybody explain to me?
I think it is
Yes.
to be paid, a tax paid on the transfer of the securities, that is shares, etc., while purchasing or selling it.
Okay. Okay. So you're right. See, we have to purchase, sell shares through the stock exchange, BSE, NSE, or other stock exchanges. It is type of what can I say, a fee or a charge that they directly collected or deducted from you whenever you are entering into any such transaction. So that is why the name itself suggests securities transaction tax. Correct?
Correct.
Now, interestingly, I go back to our previous lecture's discussion. That discussion was with respect to the flats which are owned by a builder developer. And if I'm not wrong, I think Sanjay, it was your question only.
Yes.
What will happen if it is after 2 years it is sold something, correct?
Yes, correct. I had
Now,
asked the question. Yes.
yes, over there, if you all remember the discussion, which was a very important one, I had mentioned this, I had made this clear that in case of whether an item is an asset or not, the main determinative factor is your intention. Correct? No? I hope
Correct.
you all
Yes.
remember that.
Yes, remember.
It is the intention that determines what is the nature, whether it should be called as capital asset or it should not be called as a capital asset, but it should be called as or treated as a stock in trade. The determinative factor was or is your intent of buying. Now, on same lines, at that time we were talking about real estate or buildings and flats, shops, etc. Now, on same lines, we talk about shares. Again, whether shares will be your stock in trade or shares will be your capital asset depends upon the same intention. Now, you know, since COVID, a new industry has started, which is of into trading. And now there are many people online who teach you trading. There are many people who provide you some tips for investing. There are many people who become your consultants. So now it is whole industry which has developed, especially post COVID. Now this type of a thing, let us say I take up those training courses, I hire 2-3 people, and I through their inputs, insights, and consultancy, I every day do trading. If I'm doing that, then the shares which I'm buying for the purpose or with the intention of trading will be my stock in trade. And the purchase sale, profit loss, whatever I'm earning will go to my PGBP head. However, if I'm not in that type of a daily trading, but I'm investing into shares as an investment with the intention of either getting dividends or with the intention of getting some good price in future whenever the prices go up. In that particular case, the shares are held by me as capital asset. Now, interestingly, whether my intention is capital asset or stock in trade, the stock exchange does not know, and it has nothing to do with that. Whenever you are entering into any transaction through stock exchange, they are going to charge you STT. But for me, if it is a stock in trade shares, that STT is an allowable deduction under section 36(1) in the PGBP head. But if that share is not a stock in trade and it is a capital asset, the same STT which I have paid is not an allowable deduction under section 48 under the category of expenses on transfer. So within the same act, same income tax act, different heads, different treatment for same expense. So STT paid as PGBP expense allowed under 36(1). STT paid as expenses on transfer for capital asset stock in trade, no deduction. Is this fine?
Yeah, fine. Could there be any logic behind this? That STT is allowable in PGBP but not allowable in capital gains?
The first logic, or I will say, it is the format which is first creating a problem. If you see PGBP format is like it allows everything. It does not require the name of that item to be there. Between section 30 to 37, you can claim deduction of anything except few things which are specifically debarred, right? Over there, you only require to prove one thing, that this is my business expense. Whereas when you come to HP head or other sources head or even this capital gains head, you'll find that there is a specific format which specifically provides what expenses can be deducted. So one reason is you can say the format. Second reason, if I try to draw a logic, I personally, frankly feel if I had been the lawmaker, I would have allowed SCT even in case of capital gains, because it is for me an exclusive expense on transfer. So it should be allowed as deduction. This is my understanding. But somehow they have a specific exception, we can say, and that is why it is not allowed as deduction. That is the most unfortunate part. Okay.
Okay.
Now in our format, as we all know, when we are dealing with this format, indexation is the one of the biggest components. And I'm sure everybody present over here knows the indexation concept. So if not, I'll just explain. So let us say I purchased land in the year 200809 for rupees 20 lakhs. And I'm selling it in the year 2024-25, but before 23rd July. So let us say the exact date of sale is 15th May 24. This I'm selling for 1 CR. Now, when you are computing capital gain, here full value is 1 CR. For the time being, keep aside the stamp value duty, vagara, that is okay. I know land building, we have to see that. But for the time being, I am on something else. And here the cost of acquisition is 20 lakhs. Now, if I straightforward do this computation, on the face of it, I see that there is a capital gain of 80 lakhs. But I have to understand, accept, and appreciate one very important component, that this 1 CR which I am getting today, which is around some 16, 17 years after the date of purchase, I am literally comparing it with 20 lakhs. This is today's value. This is 16 years before value. They are not at par when it comes to money value terms, or I will put in another words, inflation terms. We all have been hearing this, especially from our parents and grandparents, that the value of rupee 100 in their times, that is 20 years back, 40 years back, was very high. Means from the same 100 rupees, they could purchase the entire grocery for the month. And today, if you go to the market with 100 rupees, you can hardly I'm saying, will be able to make arrangement for your today's breakfast for the family. That is the difference. Now, what has changed? The money value or the inflation has changed. Means things have become costlier. The value has not increased. I hope you understand the difference. The same bread, which when I was in school and college, we used to buy for rupees 5. Milk bread for rupees some 7 or 8. Today, same bread we are buying for minimum 40 rupees, and then you have all those different variations in that, the wheat bread, the multigrain bread, which are even costlier. Now, what is the point? The point is the value of bread gone up, or is it that this 5 rupees has become 45 because of inflation? The answer is more the second one. So everything around us, any smallest item like bread or a big item like a plot of land, the value which you are seeing as difference is not in the real terms. There is no actual increase in the worth, if I can use this word for value. There is no actual increase in the worth of that land or building, but there is increase in the amount because of inflation. Now, if I simply compute this 80 lakhs as your capital gain and ask you to pay tax on 80 lakhs, it would be unfair because indirectly I am asking you to pay tax for the inflation, because this 80 lakhs difference, which is a simple literal mathematical difference, is not the increase in the real value or real worth of that item, but simply the inflation. So to counterbalance that inflation, section 48, third and fourth proviso. Okay, I should write here. Third and fourth proviso to section 48 have provided a formula. What is the formula? Now, this is my today's value of this plot at which I'm selling it. And this is the value of the plot in the year of purchase. Instead of directly comparing it literally, let me first bring this value from inflation of 89 to inflation of 24-25, so that this value will become comparable to this by bringing it at the same inflation. So what I do is, the formula is, I take this cost of acquisition 20 lakhs, and where you are doing it for improvement, cost of improvement, you take this value multiplied by today's inflation and divided by that year's inflation. Now, this value, in my example, 20 lakhs, is as per 89's inflation. So, if as per 89 it is 20 lakhs, how much it will be as per 24-25 inflation? And suddenly you find that this 20 lakhs, if I index it, becomes something like 75 lakhs. And now suddenly my answer changes and I get, okay, so this is the real increase in the worth of that land, or this is the real profit in real terms. So let us pay tax on this. This is the ideology of indexation. Now, with this ideology, the concept of indexation was brought into the law in the year 1993-94. Prior to that also we had capital gains, but we did not have the concept of indexation. It was brought into the law from this particular year, and the formula is provided in third and the fourth proviso to section 48. Third proviso for cost of acquisition and the other proviso for cost of improvement. But this particular concept has now been removed, or now I'll say altered, from the date 23rd of July 2024. So those who are giving exams, for whom the relevant previous year is previous year 24-25, for them this date is very crucial in capital gains. Now, why this date? Because this is our second budget, which we talked about in the previous class, the finance bill number 2, which was, if I'm not wrong, presented on this date. And this particular concept was brought in by the newly sworn in government and the finance minister, where they decided to remove the concept of indexation. Interestingly, they removed it in totality, but because of lot of pressure from politics, from press and all, and from people also in general, they had to bring some more changes. So today we have indexation, but it is having very limited application. But before 23rd July 24, that is, if your asset is transferred before 23 July 24, you follow indexation normally what you studied at Inter. But if the asset is transferred from 23rd July 24 onwards, then the indexation is as good as removed. It is now there in a limited scenario, and that also there is a very interesting working. But I hope you all understood the whole ideology of indexation. So let us get back. Please read.
The cost inflation index under section 48 for computation of long-term capital gains arising from the transfer which takes place before 23rd July 2024, the cost of acquisition and cost of improvement will be increased by applying the cost inflation index. Once the cost inflation index is applied to the cost of acquisition and cost of improvement, it becomes index cost of acquisition and index cost of improvement.
So this what I said in the formula. So here we have to take the CII, cost inflation index, for this year, and in the denominator also what we are dividing is we are dividing by the CII, that is cost inflation index, for that year. So this is the formula. Using this formula, which is now just explained in language also, in literature also, that you multiply the cost of acquisition or improvement by current CII and divide it by your original year CII. So this amount gets inflated, it gets indexed, and you get now index cost of acquisition or index cost of improvement. Fine. Please proceed.
The cost inflation index in relation to a previous year means such index as may be notified by the central government having regard to 75% of average rise in the consumer price index urban for the immediately preceding previous year to such previous year.
Now, if somebody wants to know, sir, how these index rates are computed, so this is the explanation given. Firstly, let me show you the indexation rates. So these are the rates. Now, these rates were originally from the year 81-82. I repeat, in 93-94, for the first time, we had the concept of indexation, and it took the base year as 81-82. So originally, the starting of this schedule, what you can see was not 2001-2, it was 1981-82. Then they revised, because that 81-82 is very old, and that was in fact a whole together different generation. The entire calculation of inflation by the government was using different bases and different standards. So the government changed their standards of computing inflation. So did they change this cost inflation index, and now 2001-2 has become the base year. Now there was a buzz some time back that they will change the base year to 21-22. But then COVID came, all things got derailed, and that particular point got aside, and now they have in fact removed the indexation. So now there is no question of revising the base year. But 2001-2 is the base year. Now what do you mean by base year? So whatever is the price index, or in simple words, whatever is the price of different items of that year is now your base. Now what government will do, every year they will calculate or find out what is the price of the same thing in the second year, in the third year, in the fourth year, and they will compare it with the first year, that is the base year. So you will get to know how much percentage there is increase in price. So if 1-2 is the base year, so whatever is the price, we treat it as 100. Now when they calculated the average price of the second year for the same items, they found on an average 5% increase, or actually the increase was more, as you could read above. They said that they took only 75% increase. So maybe the increase was more, but they took 75% increase. So that came to 5. So the second year's indexation became 105. Third year, let us say the increase was of 12%, but making it 75, there came to 9. So as compared to this base year, all years indexation rates have been identified, which are called as CII, cost inflation index. Correct? And how they have been computed? By taking 75% of the price rise. So whatever is the price rise, the entire is not considered, whatever is their calculation. So they are taking 75% of the price rise, and accordingly, these indexation figures are provided. Now, since 2001 is the base year, so that is taken as 100, and on that basis, all other indexation rates have been computed. Now, Section 48 proviso says that indexation shall apply to long-term assets. So if your asset is short-term, in computing capital gain loss, you will not apply indexation. You'll apply indexation only for long-term assets. Now, this is a rule. Again, this rule has an exception. So please read from here.
Below is the summary showing the indexation benefit available to different types of long-term assets, which are transferred before 23rd July 2024.
Now, as I said, the general rule is that for long-term assets computation, you should apply indexation. However, you will see in this table that for some long-term assets, now these are all long-term assets, means these are all the assets. If they are long-term, still indexation will not apply to few of these assets. Why? Because every rule in this chapter will have an exception. So the rule is long-term assets should be indexed while computing capital gain or loss. Exception. Few of these long-term assets like bonds and debentures or these assets, why these assets? Because anyways, they are considered as short-term only, not long-term. Then these assets, equity shares, units of equity-oriented fund, for them indexation benefit was not given. But this was all up to this landmark date, I should say, 23rd of July, 2024. Why? Because after that, you got the second budget and that budget has changed the whole scenario. Please read.
Consequent to the amendment made by the Finance Number 2 Act 2024 in Section 48, no indexation benefit is allowable on long-term capital gains arising on transfer of any capital assets taking place on or after 23rd July 2024.
So now when you will be handling any sum, whether practical or case study, pertaining to the previous year 24-25, if 24-25 years question is given, this date is going to be crucial. Before 24-25, we know for all years indexation is fully available except for these few assets. And for thereafter, that is from the current year 25-26, indexation is not applicable or it is applicable to limited assets or limited scenario that we are going to study. But for 24-25, you have to be very vigilant with the date of transfer. So if the date of transfer of the asset is 23 July onwards, indexation, you can say, will not apply with only one exception. Prior to that, indexation applied. Now, what is that special scenario developing from 23rd July? It is this. Please read.
Computation of X on LTCG on transfer of land or building or both on or after 23rd July 2024, Section 112. A resident individual or HUF, while computing tax on LTCG on transfer of land or building or both, has the option to take the benefit of indexation under Section 112 in respect of long-term capital gains arising on transfer of land or building or both, which is acquired before 23rd July 2024 and transferred on or after 23rd July 2024.
Okay. Now, the only limited scenario where indexation is applicable today is first, the assessee should be a resident individual or a resident HUF. First point. Second point, the asset transferred is land or building or both. So only for this limited scenario, the concept of indexation now exists. That also, it exists on option basis. Means what? You can assume or you can not assume, I'll say you can now keep in mind that indexation is completely gone. Indexation is not there in the law now. Actually, it is not. But only for the purpose of computation. Now you see the beauty, how they brought in back the indexation. Actually, on 23rd July, they removed indexation completely. How? By deleting the indexation provisions from Section 48. However, as I said, because of politics and pressure from various sections of society, etc., the government had to reinstate indexation, but then they limited it only to individuals HF who are resident and only to land building. But that also, they have not brought it back in Section 48, which is the main section which was earlier giving this benefit of indexation. Rather, they have brought it in the computation. Now, what is the impact of this? That also I'll explain. But why I'm stressing, because this is the year which has created this big change. Many people are still confused about this change. But if you follow what I'm trying to explain in detail, I'm sure this particular problem will not come to you. So First thing you should keep in mind, indexation is completely gone for all scenarios, including this one. But when you are computing the tax, for which for long-term capital gain, the applicable section is 112. There are multiple sections, but for this scenario, it is 112. Only while computing tax, interestingly, not while computing capital gain, only while computing tax, you will check two options: with indexation, without indexation. Now somebody will say, sir, what you are saying, we are unable to understand. So now I'll give you an example. First, so this was our first special case scenario in the previous class. Let me give you the second special case scenario. Now I'll take one example where I'll change one single date and the question will be changing the whole routine. So I purchased land, same example, which was below 8-9 for rupees 20 lakhs. I am Vishal Govind Prasad Poddar, resident individual. I purchase a plot of land in 8-9, which is as my investment. It is not my stock in trade, for 20 lakhs. And I am selling this. Now here, my first example is 15th May 24 for rupees 1 crore. Same example which I was showing below for explaining you the format. Now in this case, when I'm computing my capital gain for the previous year 24-25, I am resident individual. I follow this format: FVC minus expenses on transfer. For the time being, please ignore the concept of that stamp duty value comparison 105%. That we will deal with later on when we need to go into those details. Right now, my interest is not that. Minus. Now, since this transfer has taken place before 23rd of July 24, there is no option. There is a compulsion that this particular thing has to be indexed. 20 lakhs. How I'll index? I'll multiply it by indexation rate of current year, which is 363, and divided by the indexation rate of the year of acquisition, which is 137. So 363, 137. So 363, 137. This would be my LTCG. Correct? Now, I'm also showing you something else beside this. Computation of income. So I'll write COI. In the meantime, I request please compute the index cost and the final resultant capital gain. Now let us say I have in this same year, PY 24-25, salary of rupees, salary means income from salary after the standard deduction and all. Right? I have HP, which is a loss, rupees 2 lakhs. And I have this LTCG. This is my GTI, also TI. I'm ignoring deduction under Chapter 6A. And then there is tax on this TI. Has anybody computed this index cost and the resultant capital gain?
Yes, LTCG comes to 47 lakh 730. Index cost of acquisition is 52 lakh 99,270.
270. Okay. And
LTCG is 47 lakh 730. 47,00730.
Chalo, if you all allow me, I'll just round it off for simplicity of calculation. Okay? Just allow me to round off. Now, as per this, my capital gain will be roughly this much. This is a loss. This loss I'll set off here. Correct? So 38 plus this, my GTI becomes 38, that is 40 minus 2 lakhs after setting off this HP from income from salary. 38 plus this. Correct? Now when I'm computing tax on this LTCG, the tax, I'm sure you all would remember, would be at flat 20%. And on this IOS, which is now 38 lakhs after the set off, I will have slab rate. Correct?
Yes.
Now this 20% and all, this is as per this section 112 which we are studying. So there is a special computation given for LTCG. There are two sections, 112 and 112A. 112A is for those assets like shared debentures, etc. But for all other assets, it is 112. Now this was the computation, or rather, I should not say was, this is still the computation if the transfer has taken place before 23rd of July. Now we go to the second case scenario. In this same example, I change the case scenario and I make it 15th of August 24. The sale has happened with all other details remaining same. Now in this case, when I'm doing computation of capital gains, PY 24-25, FVC 1 CR, expenses on transfer nil. So net consideration 1 CR. Now please pay attention, students. I just mentioned one thing, that now you have to remember there is no indexation in the act. I repeat, there is no indexation in the act. So my LTCG is 80 lakhs. Now I come to COI. Pay attention, the difference. Same. Income from salary. Actually, I should not say, should simply say income from salary because IOS appears to be income from other sources. I'll say I. Then I have HP, which is a loss, 2 lakh. And most importantly, my LTCG, 80 lakhs. I am resident individual, same scenario what we are talking about, but this is what the loss is. So 40 minus 2, 38. 38 plus 80 is 118. Now the beauty of this all amendment. See how law, I really find it very fascinating, though as a student you all may find it very troubling, but I find it fascinating. What does this section 112 says? Now this section says, since I am a resident individual, since this asset sold is land, as you can see in my example, hence you are given option. What is the option? One is you compute tax on this 80 lakhs. First option, I'll say option 1. And the second option, option 2, I will do this working parallelly. What is this working? Sorry. I'll do this working parallelly. So now this working is my parallel working, optional working. This working is without indexation. This working is with indexation. And with indexation, my income has come to 47 lakhs. So they say, make this working parallelly. So while computing tax, because section 112 is not of computing income. Computing income, indexation has gone. Your income will always appear 80 lakhs only. I'm talking about resident individual HF and land building only. I'm not talking about other assets. For other assets, the income will be same and below you don't have the option also. But for land building sold by resident individual HF, 112 which is only for computing tax, says that do one thing. First, this income which you have computed without indexation, which is now the only law, compute the new rate. And I give you this working as an option. So only when you are computing tax, for the purpose of computing tax, do this parallel working, that is with indexation, and whatever is the income multiplied by the old rate. Now out of this, whichever amount is lower, that will be your tax on capital gain, and then income from salary 38 lakhs will be as per your slab rate only. So there is no change for that. But for this, that is a tax on LTCG, 112 gives option, but the option is not in computation of income. Computation now will always remain 80 lakhs. So while computing income, you have to only show this as your working. If the transaction is after 23rd July, any asset, and any assessee, the working remains same. But when you are computing the tax liability, at that time you see, okay, assessee is resident individual HF, asset is land building both, then only in computation of tax, this option has to be checked, and then you can take the tax liability, whichever is lower.
Yes.
Now, interestingly, 12.5% on 80 lakhs comes to, I think, 10 lakhs.
10 lakhs.
And 20% of this will come to, I think, 9.4 lakhs.
9,40,000, yes.
So your liability will be 9.4 lakhs. Interestingly, now see the beauty of this. The income will continue to appear as 80 lakhs only, but the tax on it will be of this. So income 80 lakhs, tax 9.4 lakhs. Now how it will happen? So the law says the tax on this will remain be 10 lakhs only, because that is what is the tax coming on 80. But like how you have the concept of rebate, this difference will be given to you as the rebate. So your final tax liability for paying tax will become 940. What we are simply saying, take whichever is lower. In the language of law, see, now income, if it is 80 lakhs, then the tax has to be 10 lakhs only. So the tax is 10 lakhs because the income is 80 lakhs. But because we want to give you this relief, you find out both the taxes. If this tax is lower, then whatever is the difference, show it as a rebate so that your final liability to pay comes to 9.4 lakhs. See the manner how law gets drafted.
Yeah, and this rebate comes under section 112 only.
No, you can say 112 only. There is no, it is not coming in 87A or 87B, no, nothing. Okay. So this is all under 112 only. Students, have you understood this?
Yes.
See, what fascinates me more, in this subject of taxation especially is, what is the thought process of the lawmakers? That when they have to bring some amendment, and you can understand, now I'll use a word which people will say, no, you are taking a stand from the government, but I really feel sorry for these chaps. They are poor in the sense, so much burdened they are, that firstly, they amended the law saying that, okay, indexation is gone. Now, because of political pressure, government comes back to the drafters who are drafting this saying that, no, I want to bring indexation, but with only limited applicability. Now, see, understand this, the thought process. They could have reinstated 48 computation and they could have reinstated the proviso in that, giving indexation. But very thoughtfully, very mindfully, they felt that that would create some other problem. So very thoughtfully, they said, no, let the computation remain same. Let that indexation be gone from 48 completely. But since you want to give relief, let us give it relief in the form of a rebate in the tax computation part. So this is what fascinates me, how the lawmaker could be thinking. See, today we are finding some difficulty, some confusion in interpreting. But the one who crafted, how that person would have thought of creating this type of amendment and bringing into place what the government also wants, and also keeping in intact the original theme that we don't want to give indexation. Both things are achieved with this beautiful logic of creating that particular thing only in the computation of tax, not in the computation of income. Now, I hope you all are getting this, students.
Yeah, got it.
Anybody has any doubts or questions in this? Because today this is the most supposedly difficult or confusing part of capital gain that students find. But I believe if you understand and go by the logics and the flow, how it has come to this stage, it will be easy to understand, and especially when you keep this example in mind.
So the landed building purchased after 23rd July 2024, if it
No,
is
no, no,
sold,
not purchase, sold.
I'm asking if it is purchased after 23rd July, then there will be no indexation, only flat rate of 12.5%.
Perfect.
Right. Okay.
So it is, see, now it is why I'll tell you why this had to be done. Because many people, what they complained, that we had purchased or we had invested in land building with the expectation that whenever we sell, we'll get the benefit of indexation. Now you cannot take away that benefit, because at the time of purchase, we had taken the decision on that grounds. So they brought in this amendment saying that, yes, if it is purchased before 23rd July and sold after that, we are giving this option. And as you rightly pointed out, now for all fresh purchases after this, now you very well know that you are not going to get indexation. So it is your choice whether you want to invest or not invest. Correct?
Right.
Now, Chitra, what you have pointed out is perfectly right. This is done with the intention of create. Now, what is the impact? See, if you want to give me the benefit of indexation, so how I am affected? You are still affected. Why they applied their minds and brought this type of amendment in the tax computation? Because they wanted to keep the surcharge liability alive. And as you can see from this example, because of keeping the computation without indexation, your GTI and TI may exceed the surcharge limit, which is not happening when indexation is given. So you are very correct, Chitra, when you have identified or pointed out this, that this is with the intention of keeping you in the surcharge bracket if your income without indexation is crossing the threshold of surcharge. Plus, it will also bring you in all those brackets wherever any type of relaxation or relief is based on your total income. Like if you remember, AMT calculation, alternate minimum tax, is also based on your taxable income. So if taxable income is below a particular threshold, AMT is not applicable if it is above threshold. So all those type of things will trigger because of this particular amendment. No, beta, Neha, in this example, it is coming to 60,000, the rebate. For see, it is not a rebate. I've used the word to explain you. There is no such word given in the law. But just to explain you what we are deducting, it is, I've used the word rebate because you all are familiar with that. First thing. Second thing, it is not limited to 60,000. In this example, the difference is 60, so I've written 60. So whatever will be the difference, that is if your 20% tax is coming lower, that is the tax with indexation applied, if that tax is lower, the government said we will give you the benefit of that tax. How? By adjusting the difference. And that difference can be any amount. Fine. Okay. Now, if you all have understood this, now whatever you'll read from here will make some sense. Please read.
Yeah. Computation of tax on long-term capital gain on transfer of land or building or both on or after 23rd July 2024, Section 112. A resident individual or HUF, while computing tax on LTCG on transfer of land or building or both, has the option to take the benefit of indexation under Section 112 in respect of long-term capital gains arising on transfer of land or building or both, which is acquired before 23rd July 2024 and transferred on or after 23rd July 2024. Accordingly, LTCG on transfer of such land or building or both are subject to lower of tax at the rate of 12.5% on LTCG computed without indexation benefit or 20% on LTCG computed with indexation benefit.
So we have seen this. So ultimately, if you satisfy all these criterions, you will be getting this option. Obviously, you'll go by that option where the tax liability is lower. Please proceed.
It may be noted that this benefit to a resident individual or HUF is to be given only while computing tax on LTCG under Section 112 on transfer of land or building or both, and not while computing income under the head capital gains, which would form part of gross total income. Thus, for computing income under the head capital gains to be included in gross total income. Indexation benefit is not given even in the case of resident individual HUF transferring land or building or both on or after 23rd July 2024, which was acquired before 23rd July 2024.
So simply put, indexation is not there in the law. Simple. So you have to keep this in mind for whoever you are computing the capital gain and for whichever asset you are computing the capital gain after 23rd July 24, if the transfer takes place, there is no indexation at all. So for everyone, you will compute the GTI, and for GTI, you will compute the capital gain only with the method of without indexation. Only where above conditions are satisfied, when you reach the final stage of your computation, that is, you have computed GTI, you have computed TI, now you are on the last stage, that is computing tax liability. At that time only, internally in working notes, you will have this with and without indexation workings. So in the main computation, this working is no more present. Is this clear to everyone?
Yes, clear.
Perfect.
Perfect.
This will stay with you all till the end
Yes.
of your at least exams.
Yes, even after exams.
Great. Then I'll be obliged if you can keep it even after exams. Okay. Now some more provisions given under section 48. This point is now no more relevant because this is applicable only if the transfer had taken place up to previous year 23-24. That is why AY 24-25. Now this is not relevant because you all know our exams will be dealing with transfers which are happening in 24-25 and thereafter. So this particular provision is not applicable now onwards. It was there up to the last financial year, that is 23-24. But just for academic purpose, we'll go through this. But for all exam purpose, you can very well ignore this. Please read.
Full value of consideration of shares, debentures, or warrants issued under ESOP in case of transfer under a gift, etc., up to assessment year 24-25. In case where shares, debentures, or warrants allotted by a company directly or indirectly to its employees under the ESOP or employee stock option plan or scheme in accordance with the guidelines issued in this behalf by the central government are transferred under a gift or irrevocable trust, then the market value on the date of such transfer shall be deemed to be the full value of consideration received or accruing as a result of transfer of such asset.
So this particular provision, which is now removed, is applicable only where you are an employee. You had received some asset, share, debentures, etc. of your employer company under ESOP, and this you did not sell, you gave it by way of gift. So that was deemed to be a transfer at that time before financial year 24-25, that is up to financial year 23-24. And at that time, what would be the full value is given over here, which would be the fair market value, not applicable. Now,
This is the gift. You are saying gift by the employee or gift by the company?
no. Good question. So now Sanjay has put a very practical point. Ki, sir, what point is covered here? Now, first step is the company gives the ESOPs to the employee, which is also like a gift. See, at times they charge you some amount, which is nominal, but many times they give you free. Now, when the company is giving to the employee, are we talking about that scenario? Answer is no. Why? Because when the company gives to the employee, in the hands of employee, it is a salary income. It is a perquisite as per section 17(2). I forgot the clause, some 5, 6 something. So that is not covered here. And that is still there in place. So today also, if a company is giving ESOPs to its employees, in the hands of employee, there is income, but it is under the head salary. It is treated as a perquisite under 17(2). However, now what we are talking about is when this employee who has already received this ESOP from its company is selling the ESOP. Now I'm using the word selling. If he is selling the ESOP, you don't require this section because this section is not covering that scenario. So where the employee is transferring the asset, which is an ESOP, today also it is taxable in the hands of the employee and it is taxable as per normal 45(1). Full value will be the sale price minus cost of acquisition, etc., etc. But where today the employee is not selling this ESOP but gifting it to some other person. So now this scenario covered only the second leg where employee gifted it to some other third person. That was deemed to be a transfer up to the financial year 23-24. And since it was deemed to be a transfer, there was a deemed value, which is the fair market value. Now the deemed transfer itself is gone because gift we already are reading is not transfer. So once you are gifting today, if an employee gifts his ESOP to someone, it is not transfer. There is no requirement of full value because if it is not transfer, why full value will be required? Perfect.
But if the employee sells it in the market, then it is taxable.
Yes, because it is a normal sale, it is taxable.
Right. Yeah. Right.
Correct. Now,
Correct.
Now we come to another special case scenario, which is covered by first proviso to section 48. Now see, I just showed you the Bear Act in which one, there was a proviso to cost of acquisition, which we just read about that interest part. If it is already allowed as reduction under HP, it will not be allowed or considered as cost of acquisition, etc. Now you can see there are multiple provisos here. Now this proviso 1, is what we are talking about right now. This special case, what we are talking about is proviso 1. What is this proviso 1 saying? Let me first explain you again with a practical example so that understanding the theory or the provision would be easy. Now again, we are dealing with a special scenario which is covered by first Now, this special scenario applies to a scenario where a non-resident had purchased shares or debentures of Indian company by payment in foreign currency. Now, what scenario is covered in first proviso? A non-resident had purchased shares or debentures of Indian company, but the payment was made by this person in foreign currency. Now, let me give you an example. So, Mr. J, I think N, T. I hope you all know this famous person. No, J,
Yes.
T. Who is he?
Tata.
No. Sorry, I want to change. D, some JT. Okay. I'll just write. Now you understand? He is D, some J, T, na?
Yes.
Okay.
Understood.
Fine. No, not DT only. There is some, I think, father's name in between. So,
Yeah,
okay.
J.
Now
I think it is J. Yeah.
Yeah, it is DJT. So now you all understand, correct? Now this superhuman person, he purchased shares of, let us say, Reliance Industries in the year 2015-16. Let us say 10,000 shares, which were priced actually at rupees. Shall I take a figure which will be easy for me? 75. So it should have been rupees 7,50,000. But at that time, let us say the dollar rate was $1 is 75 rupees. So he actually paid for this. How much it will be? $10,000. No? Okay. So he purchased these shares by making payment of $10,000. This all happened in 15-16. Now, because of his special love for our country and the special love which he is showing now, he decides to sell these shares in 2024-25. Let us say after hearing Modi ji's speech of 15th August, he decides to sell these shares. Now he's selling these shares at today's price. Today, let us say Reliance shares have gone to rupees 500. So what he will be receiving will be rupees 50 lakhs. And let us say there are some expenses on transfer, not STT, because STT we all know is not allowed. Let us say some agent or some brokerage, what he has to pay. Let us say that comes to rupees 2 lakhs. Now, in this example, what does the first proviso says? Computation of CG. Here your previous year is 25-26, which is ongoing. Now, normally how I would have calculated this? I would have calculated this by taking full value as 50 lakhs, expenses as 2 lakhs, and cost as 750. However, since originally the person purchased by making payment in a foreign currency, this special computation, which is as per first proviso to section 48, it states that we will do all computation in dollars so that the capital gain that you will get will be in dollars. But even if you compute capital gain in dollars, how will you take tax? Because tax has to be taken in rupees only. So they say only for the purpose of computation, do it in dollars, then we'll convert it to rupees. Now, how this is to be done, that is provided for in the law. And the law says, even though the transactions are happening in Indian rupees, so we know it is 50 lakhs. We know this is 2 lakhs. We know this was 7,50,000. But what you have to do is you have to convert all these figures from rupee to dollars. Obviously, for doing this, you require some exchange rate. So they are saying that there is something called as telegraphic transfer rate. So the exchange rates which we are using, especially the banks, they are called as telegraphic transfer rates, TTR. Telegraphic transfer rates. Now in this, there are two rates. One is the buy rate and one is the sell rate. So you all would be knowing banks have two rates. One, the rate at which they will buy the dollar, and two, the rate at which they will sell the dollar to you. Correct? So that is telegraphic transfer buy rate, telegraphic transfer sell rate, and obviously then there will be an average of these two rates. Now what they are saying, that take the average rates for converting these three values, 1, 2, 3. But average rate of which date? The answer is the date of transaction. Which transaction? Or the date on which these figures have come into picture. Now, if you observe, both these things would have happened today. The full value you received today, the expenses on transfer you incurred today. And this would have happened in the year of purchase. So you have to take average rate of 16th August 2025 for first two values, and you have to take average rate of, let us say this date was also 16th August, just for simplicity. So you have to take average rate of 16th August 2015. So you find out both these rates and take the average. Now let us say today's average rate is coming to, anybody knows today's actual rate of dollar to rupee, some 96 something. No? Anybody knows the rate? I think I should have somewhere here. Anybody knows today's rate?
It shows 88.12.
So it is 88 only?
88.12, yes.
Okay. So it is 88.12. Just for simplicity of calculation, I'm saying the average rate. Anyways, we want average. So buy rate, sell rate, there are two rates. This is 88, this is 90, or sorry, it is 87 and 89. So it is 88. Correct. This is of this date. And for 2015, let us say the rates were 74, 76. So it was 75. Now what I will do is I'll convert these Indian values into dollars, taking the average rates of the date on which this figure or this transaction has arisen. So 50 lakhs divided by 88. Can somebody help me with the value?
56,818.18.
880.18, na?
18. 56,818.18.
Okay. Give me this conversion. 2 lakhs upon 88.
2,272.73.
270.
2.73.
73. So I'm just rounding it off. So this is becoming, that consideration is becoming 54, 5, 45. Correct, no? And this will be 10,000. So my capital gain would be 44,545 in dollar terms. But I want to pay tax in India, so it has to be in rupee terms. So I will take today's buy rate and I'll convert it at today's buy rate. So multiply this 44,545 by 87, which is today's buy rate. How much it comes to?
Yeah, 38,75,415.
415.
415, yes.
So this is your capital gain on which Mr. DJT will have to pay tax in India. Rupees 38,75,545. What is special in this? The first proviso has provided this mechanism that you compute the entire capital gain in the foreign currency. Which foreign currency? Paying which you purchase these shares in the first case. And then converting this foreign currency capital gain to rupee capital gain. Now for all these conversions, we have to use the TTR, that is the telegraphic transfer rates, the buy rate, the sell rate, the average. This is what is first proviso. Now you read, now you'll understand everything.
Yeah. Special provision for non-residents. In case of non-residents who invest foreign exchange to acquire capital assets, capital gains arising from the transfer of shares or debentures of an Indian company is to be computed in the following manner.
So firstly, you are a non-resident. You had purchased this capital asset by making payment in foreign currency. This is very important. Even if you are non-resident and originally you had purchased this by making payment in rupees, this provision is not applicable. You fall in the normal calculations, which we are parallelly studying. But if you had purchased this, as you can see, who invest foreign exchange to acquire capital assets. So original payment, even though rupee value was 7,50,000, but you took that day's conversion rate, 75 average conversion rate, and you paid $10,000 to the company or to whoever person from where you are buying, then only this calculation is applicable. Now, if these conditions are satisfied, originally you acquired it by paying foreign currency. Now, today when you are transferring it, the capital gain will be computed as follows. The format remains same: full value, expenses, cost. But what is to be done? Please read.
The cost of acquisition, the expenditure incurred wholly and exclusively in connection with the transfer, and the full value of the consideration are to be converted into the same foreign currency with which such shares were acquired.
So in short, all the three figures, full value, expenses, cost, have to be converted to foreign currency, which we did. We first converted it into dollars. Why dollars? Because it is the same currency with which these shares were originally acquired. Go ahead.
Yeah, the conversion has to be done at the average of the telegraphic transfer buying rate (TTBR) and telegraphic transfer selling rate (TTSR) on the respective dates.
Of respective dates. Respective dates means the date of these values. Now, full value and expenses on transfer are today's value. So I've taken today's average rate, average of buying and selling rate. And cost of acquisition is of the year of acquisition. So I'll take the average rate of the year of acquisition. Please read.
The resulting capital gains shall be reconverted into Indian currency by applying the TTBR on the date of transfer.
Again, the capital gain is arising today. So the date for reconverting it into rupees has to be today's date. But for reconverting, we are not taking buying or selling rate average. We are only taking the buying rate. This is how this whole working is done.
Yeah, this is
sorry, just let me complete. The provision is given in first proviso to section 48, read with rule 115A. So all these which rates have to be taken and all, this you will not find in the Bare Act. So if I switch to the Bare Act, it is the Bare Act, I think here. In the Bare Act, they have not given how to convert. They have only said that you will do calculation. So compute by converting the cost of acquisition, etc. Received as a result of transfer into the same foreign currency as was initially utilized in the purchase of shares, and the capital gain so computed in the foreign currency shall be reconverted into Indian currency. But they have not mentioned at what rates, buy rate, sell rate, average of which date. All this is given in the rule 115A. So, however, that the aforesaid manner of computed capital gain shall be applicable in respect of capital gain accruing or arising from every reinvestment thereafter, etc., etc. So even for further reinvestment, the same thing will continue. But the point is, what I'm trying to highlight is that along with this proviso, you have to read 115A, where the specific details are given as to what day's rate, which rate, etc. Correct? Go ahead.
The aforesaid manner of computation of capital gains shall be applied for every purchase and sale of shares or debentures of an Indian company. This will provide relief from risk of foreign currency fluctuation to non-residents. Rule 115A is relevant for this purpose. Benefit of indexation will not be applied in this case.
Now, this benefit of indexation was not applied originally also before 23rd July, and anyways now after 23rd July, it is applicable in no case. But this point is not given for case after 23rd July, or else they would have mentioned that. This originally in the law itself, there was no indexation given to them. Please proceed.
On long-term capital gains arising from transfer of unlisted securities or shares of a company in which public are not substantially interested, non-residents and foreign companies are subject to tax at a concessional rate of 10% without indexation benefit or currency conversion, if such transfer takes place before 23rd July 2024, and at the rate of 12.5% without indexation benefit or currency conversion if such transfer takes place on or after 23rd July 2024, section 112.
So what has changed on this date is only the tax rate, correct? But this is applicable to whom? Long-term capital gain arising from unlisted securities, shares of a company in which public are not substantially interested means private company. Not interested means private company. Non-resident and foreign companies are subject to tax rate. So again, this tax rate of 10% and 12.5% is applicable only in this specific scenario. Our above scenario is also covered, but partly covered, where it is of private company and that also of unlisted shares and securities. Go ahead.
Rupee denominated bonds. As a measure to enable Indian companies to raise funds from outside India, the RBI has permitted them to issue rupee denominated bonds outside India. Accordingly, in case of non-resident SSCs, any gains arising on account of appreciation of rupee between the date of purchase and the date of redemption of rupee-denominated bond of an Indian company held by him against foreign currency in which investment is made shall not be included in computation of full value of consideration. This would provide relief to the non-resident investor who bears the risk of currency fluctuation.
So
Note.
for this special case, that is rupee denominated bonds, firstly, what are they? These are the bonds whereby, as you can see, the RBI has permitted them to issue rupee denominated bonds outside India. So in this case, the non-resident assessee who are investing in these bonds, if there is any gain arising on account of appreciation of rupee, how appreciation will happen, we all know. So you need to take the exchange rate originally of the date of purchase and exchange rate of the date of transfer. And whatever is the increase in the rupee value, that will be removed. And how that will be removed? Something similar to the above working. So what above working we did was basically to erase out the foreign currency fluctuation impact, because we converted both at the respective date to dollars, and now everything is in dollars at respective dates rate. So automatically the foreign currency fluctuation gets removed by the above working what we did. So this is how even this working is done. So why this is done? This is to provide relief to non-resident investors. Now see, you all know in past few years or a decade, you can say, we have opened our doors for many foreign investors. Even direct investment is allowed, FIIs are allowed. So for them, how we made them lucrative? By giving them many tax benefits like lower tax rate, as you saw, about 10%, or here by asking them to pay only on the actual gain and not the foreign currency fluctuation. Fine, just read this note.
Note, the benefit of currency fluctuation would not be applicable to the long-term capital gains arising from the transfer of the following assets referred to in section 112A. Number 1, equity share in a company on which STT is paid both at the time of acquisition and transfer. Number 2, unit of equity-oriented fund or units of business trust on which STT is paid at the time of transfer.
Now please understand, there are two sections for computing long-term capital gain, 112 and 112A. 112A specifically applies to these assets. What? Equity shares on which STT is paid on both sides. So for that, anyways, all the above workings what we have studied is not applicable. Above workings are applicable only where STT is not paid. Hence, there are two provisions. So whatever we studied above, for that, you have to ensure that the assets are such that STT is not paid. Then only you go by the above working by converting it into dollars and reconverting into rupees. If it is covered by 112A, and when it will be covered where the equity shares are such that STT is paid at both ends, then you will forget all the above workings above and you will do workings normally what is given in 112A, that is without converting it into foreign currency and reconverting to rupees, because that is done to erase out the foreign currency fluctuation impact. But that won't be done if your assets are 112A assets. Is this understood by all? ठीक है ना? I know things are too technical, but that is the beauty of this chapter. Fine? Understood? Chalo. So we'll take a 15 minutes break just to ease out the burden from your minds. You can just chill out, relax. We'll restart by going further. And now the next part would be a bit lighter because not much technical will be there. Yes, there would be many provisions, but it would be easy to read and understand. So now from here onwards, we'll be discussing some provisions and not any technical computation. So it is around 7:45. So in 15 minutes, we rejoin. Fine?
Right. Okay.
Now, when we go by this format, it says that while computing capital gain, from the full value of consideration, you have to deduct two things: expenses on transfer and cost of acquisition and cost of improvement. Now, this cost of acquisition has been defined as per section 55. If you see, there is no definition of cost of acquisition. Only here in the explanation, they have given you the computation of index cost of acquisition, but they have not given you the definition of cost of acquisition. So for definition of cost of acquisition and cost of improvement, we go to section 55, and along with 55, we go to the different relevant other sections where cost of acquisition and improvement is defined. So let us first go to the basic definition of cost of acquisition and improvement, and then we go to the special provisions. Okay. Now see, meaning of adjusted, cost of improvement, cost of acquisition. And then what it says, for the purpose of section 48 and 49. Then you have clause A, you have clause B. Now, clause A is defining cost of improvement, where it is giving you definition in two parts. And subsection 2 defines what is cost of acquisition. Again, it is defining cost of acquisition, again with respect to some specific capital asset like goodwill, etc., etc. So what you can see is here, whatever definition of cost of acquisition and improvement is given, it is with respect to some specific case scenarios. Now the question is, besides the specific case scenarios, what is the general meaning of cost of acquisition? Now, the general meaning of cost of acquisition is same like accounts. What was the generic meaning of cost of acquisition in accounts? The generic meaning of cost of acquisition in accounts is the cost at which you have acquired the asset. All expenses till the date the asset is first put to use, the asset becomes ready for use, that is cost of acquisition. So this is the first and the basic meaning of the term cost of acquisition. What is cost of improvement? Again, the generic meaning besides these special cases is that cost of improvement would mean all expenses that are incurred to increase the value or the life or the usability. So wherever you are bringing any improvement, and improvement means higher side. So you are increasing the value, the cost means, the value or the life or its usability, that will be cost of improvement. Now, this is what is the generic meaning. Now, main section 55, which is supposed to be the defining section, is actually giving you some specific or special provisions relating to cost of acquisition and cost of improvement. Now, not only these, as you can see, the reference is made for 48, 49 also. 48 because it is the computation section, and 49 because again there are some special case scenarios given for cost of acquisition in 49 also. But before that, let us read what is given in section 55 relating to cost of acquisition and improvement. So you may please start reading.
Yes, section 55, subsection 1. For the purposes of section 48 and 49, clause B, cost of any improvement in relation to a capital asset being goodwill or any other intangible asset of a business, or a right to manufacture, produce, or process any article or thing, or right to carry on any business or profession, or any other right shall be taken to be nil. And
simple. So what it has said, 55(1)(b) says that for any intangible asset. So originally this section only started with goodwill. Later on, they realized that it cannot be limited to goodwill. So they added the word any other intangible asset. Now we know what are the intangible assets relating to business, like patent, copyright, trademarks, All these are your intangible assets. Or further, it says the right to manufacture, etc., etc. So whatever are the intangible assets, for all intangible assets, the cost of improvement, not acquisition. We are talking about improvement, be clear. The cost of improvement will always be nil. This is point number 1. Next.
2. In relation to any other capital asset, 1. Where the capital asset became the property of the previous owner or the SSE before the first day of April 2001 means all expenditure of a capital nature incurred in making any additions or alterations to the capital asset on or after the said date by the previous owner or the SSE. And in any other case means all expenditure of a capital nature incurred in making any additions or alterations to the capital asset by the SSE after it became his property and where the capital asset became the property of the SSE by any of the modes specified in subsection 1 of section 49 by the previous owner, but does not include any expenditure which is deductible in computing the income chargeable under the head interest on securities, income from house property, profits and gains of business or profession, or income from other sources, and the expression improvement shall be construed accordingly.
Okay. Now, the cost of improvement is defined in two parts. First, in relation to intangible, it is nil. Fine. In relation to other assets, so other means tangible assets like land, building, machinery, etc. What it says, it has divided it into two parts. If you have acquired the asset before 1st April 2001, now what is the relevance of this 1st April 2001? It is the base year for considering indexation. And one more relevance which you will realize as we proceed, that since indexation is to be done taking the base year as 1st April 2001, it means there is no indexation for earlier period. Now let us say my property is purchased in 1994 for rupees 20 lakhs and I'm selling it today, and let us say I want to index it. I don't have the indexation rate for 94-95. So when we will read further, I'm sure you will recall this, that if any asset is acquired before 1st April 2001, the cost of acquisition, the next point that we are going to study, says that you will take the cost of acquisition as higher of the two values. What are the higher of the two values? One, its actual cost, or the second is the cost, or sorry, not cost, the FMV on 1st April 2001. Now, this provision, if you all recall, why am I saying this? Because if you all have studied capital gain, definitely this would be resounding to you, that if an asset is acquired before 1st April 2001, you are given the option to take higher of the values, your actual cost or the FMV on 1st April 2001. Now, in this particular case, when you take higher of these values, the most important point is, please keep this in mind, the most important point is why this particular provision is there. The reason for this provision is I cannot give you indexation rate of 94-95 because my indexation base year is 2001. So how will you index any asset which is of 94? So they said that do one thing, take the 1st April 2001's fair market value as the cost. Now by providing this, what they have done is they have indirectly indexed your cost from 94 to 2001. Because the moment you take the fair market value of 2001, that would be as per the inflation of 2001. So automatically your cost get indexed up to that date. And from 2001 onwards, I am giving you the indexation rates. So understand firstly the logic of that. Now, once you understand the logic of that, which is the point relating to cost of acquisition, now I come to this point, which is relating to cost of improvement. Now, what this point is saying, if you read this minutely, it is saying that for the properties which is acquired before this date, we will consider the expenses of any addition, alterations, like what we call as improvement, which have taken place on or after this date. In other words, this point is indirectly saying we will not allow you any deduction of any improvement done before 1st April 2001. Now, is there a logic for this? Yes, there is a logic. What is that logic? I'll give you an example. Same example of my 94 asset. 94 is So what is this asset which I purchased in 1994? It is a building with ground plus first floor. I purchased it for rupees 15 lakhs. Then in the year 98, I constructed the second floor at a cost of rupees 3 lakhs. Now, if you look at the definitions and the concept, cost of acquisition is 15 lakhs, the purchase price, and this second floor price, which is 3 lakhs, the cost, is my cost of improvement. Now, when comes this 1st April 2001? What does this 1st April 2001 rule says? As I just explained 2 minutes back, that the cost of acquisition will be higher of actual cost, which is 15 lakhs, or FMV of this asset on 1st April 2001. Now, if you look at this, the FMV will be of the whole building, which is of ground plus first plus second floor. Now, when I'll find out the FMV of the whole building, it will already be covering the second floor also, which is the improvement. Since this improvement will always be would already be covered under this 1st April 2001 FMV, hence it should not get again deducted under the name of improvement. That is why this provision says that for any improvement done before 1st April 2001, you will ignore. Means any improvement before 2001 should not be considered as improvement. Only improvement after the said date would be considered. And then the second part is in any other case. Any other case means asset is acquired after 1st April 2001, no problem. Whatever is improvement done, all will be considered because by default the improvement would be done after 1st April 2001. So the only important point in cost of improvement is, first point says of intangible assets it is 0, and of tangible assets any improvement done before 1st April 2001 has to be ignored. This is the simple logic and the point. I hope this is understood by all. And
Yes.
there is no doubts in this. Correct?
Yeah, correct.
Now we go to cost of acquisition of again some special case scenarios. Please read.
Subsection 2. For the purposes of section 48 and 49, cost of acquisition, A, in relation to a capital asset, being goodwill of a business or profession or a trademark or brand name associated with a business or profession, or any other intangible asset, or a right to manufacture, produce, or process any article or thing, or right to carry on any business or profession, or tenancy rights, or stage carriage permits, or loom hours, or any other right, in the case of acquisition of such asset by the SSC by purchase from a previous owner, means the amount of the purchase price, and 2, in the case falling under subclauses 1 to 4 of subsection 1 of section 49, and where such asset was acquired with the previous owner as defined in that section by purchase, means the amount of purchase price for such previous owner, and third, in any case shall be taken to be nil.
Simple.
Provide.
Now again, what they are talking about is, the case they are talking about is, so clause A deals with again intangible assets. As you can see, and intangible assets, cost of acquisition is discussed. So one thing is clear, intangible asset cost of improvement was discussed above, it was nil. Now we are talking about cost of acquisition. And if you look at this, it simply says one thing, wherever you have purchased the intangible asset, the cost will be the purchase price. Now it may be both cases, your case or the previous owner's case. What is that previous owner case? Our golden rule 1. That will be coming to very shortly. So wherever intangible assets are concerned and you are talking about cost of acquisition, there are two propositions. One, if it is purchased. Two, which is this point, any other case. Any other case means where it is self-generated. Now, in case of intangible assets, we all know there is a very good possibility that it may be self-generated. How? The goodwill, best example. So I start my own office, my own profession. Over a period, once this becomes a brand name, tomorrow if I'm including somebody as a partner in my firm, in my profession, I charge goodwill because I have already developed some brand name for my firm. This is where the goodwill of intangible assets comes, but this is a self-generated goodwill. So it will fall in this subclause 3 where they say that if it is self-generated, it is nil. But where you have purchased it, so the amount of cost will be the purchase price. Now in this case, it is of previous owner, and in the previous case, it is the purchase price by you. So whoever has purchased it, if originally you have, let us say, you have purchased goodwill of some existing firm or business, and you are now running that business under that goodwill. Now, while purchasing that goodwill of that existing business or firm, whatever price you paid for purchase of that goodwill will now be your cost of acquisition. So, to conclude, for intangible assets, cost of acquisition will be the purchase price if it is purchased. If it is self-generated, it is zero. For the same intangible assets, in both these cases, whether the intangible asset was originally purchased or self-generated, the cost of improvement will always be zero. So be clear now, I'm aligning both the provisions because now when you will be dealing with any example or question, it would be case-based. So case is what? Intangible asset. Cost of acquisition 2 and cost of improvement 1. Is this clear?
Yes.
Proceed.
Provided that where the capital asset being goodwill of a business or profession in respect of which a deduction on account of depreciation under subsection 1 of section 32 has been obtained by the SSE in any previous year preceding the previous year relevant to the assessment year commencing on or after the first day of April 2021, the provisions of subclauses 1 and 2 shall apply with the modification that the total amount of depreciation obtained by the SSE under subsection 1 of section 32 before the assessment year commencing on the first day of April 2021 shall be reduced from the amount of purchase price.
Now, what does this proviso say? That in both these clauses, 1 and 2, we had said that whenever the goodwill is a purchase goodwill, you take the purchase cost. However, both these clauses have one small modification that if you were allowed depreciation under section 32(1), we all know PGBP had 32(1) deals with depreciation. So if you were allowed depreciation towards this same goodwill, towards this same intangible asset, and that depreciation was claimed by you, then the small modification would be that now your total cost has to be reduced by the amount of depreciation. So this is logical. Since you have already got the benefit of some portion of the cost in the form of depreciation, so to that extent, I cannot give you deduction again in capital gains. So again, a very logical point that the amount of depreciation claimed by you in any earlier periods would be reduced. Now here, they have given a reference of a particular assessment year starting from this date. Why? Because today, depreciation on this intangible assets goodwill is not allowed, but it was allowed up till 1st April 2021. And hence this point says that they has obtained by the assessee in any previous year preceding the previous year relevant to the relevant to this assessment year. Because up till this year only, you were allowed depreciation on this intangible asset. Thereafter, no depreciation is allowed, so there is no question of reducing it. But you need not get into this technical point of remembering the date. The simple logic is your purchase cost, let us say acquired this business's goodwill for 100 crores. Now, if you are selling this goodwill, I will allow deduction of this 100 crores. But if you have claimed depreciation for whichever year in income tax, that has to be reduced. So in those periods, you have claimed depreciation up to 20 crores out of 100. So that will be reduced. So now your cost will be 80 crores. I hope this is simple and understandable to all.
Yes,
Go
clear.
ahead, please.
Clause AA. In a case where by virtue of holding a capital asset, being a share or any other security, within the meaning of clause H of section 2 of the Securities Contract Regulation Act 1956, 42 of 1956, hereinafter in this clause referred to as the financial asset, the SSE A becomes entitled to subscribe to any additional financial asset, or B is allotted any additional financial asset without any payment, then subject to the
Now, what this particular point deals with? This point deals with cost of acquisition for two types of asset. Capital A deals with right shares. Capital B deals with bonus shares. So firstly, please understand the meaning of the language. So if you see the language, firstly, they are talking about which capital asset. The capital asset is shares or any other security. And then it says, what is this capital asset? The capital asset is the capital asset which you have become entitled to subscribe or is given to you without any payment. So basically, capital A is right shares, capital B is bonus shares. Now, what is the cost of acquisition for both these? Please apply the logic of intangible assets here. Your answer will be easy. What is the logic? If you have acquired it by making payment of some price, that is, you have purchased it, like in case of right shares, you purchase by making some payment, though it may be a discounted amount because you are the original shareholder, so right shares may be offered to you as at a favorable price, whatever it is, but you have paid some price for right shares. The actual cost or the price paid is your cost of acquisition. Fine. But in case of bonus shares or in case of rights, your cost of acquisition is nil. So the answer is very simple. For bonus shares and for right shares, the answer is what will be the cost of acquisition? The answer is what you have actually paid. So if you have actually paid something, that amount is your cost of acquisition. And if it is not paid, like rights and bonus shares are freely allotted, you are entitled because you're originally a shareholder, then the cost of acquisition will be zero. I hope this is clear.
Clear.
Any questions about this?
No, it is clear.
Perfect. Now there is a clause AB. But before I explain clause AB, I would like to revisit one point. That is my golden rule 1. Now, what this golden rule 1 was dealing with? It was dealing with a special case scenario, that is where you acquired any asset in one of the ways which is not transfer. So first point was your period of holding will not be counted from your date, but from the date of previous owner or previous asset. Correct? That was for period of holding. Now, most important point, what is the cost of acquisition of this asset to you? The answer is the cost of acquisition to you is cost of acquisition to previous owner, or it is the cost of acquisition of so where in the case of gift and all, where you have acquired asset and at the time of acquiring, there was no capital gain. Why? Because this method of acquiring, that is gift, was not regarded as transfer. So for you, the cost of acquisition is cost of acquisition of your previous owner. Similarly, we studied other cases of non-transfer where share debentures got converted to shares or preference share got converted to equity shares, or in the case of amalgamation, you gave away shares of old company and got shares of new company. In case of demutualization of stock exchange, you gave away your membership and you got the shares in the new stock exchange. In all these cases, these exchanges whereby you gave the old asset and you got the new asset, in such case, these exchange were not considered as transfer. Now the question is, for all these cases, what will be the cost of this new asset? The answer is the cost of new asset will be the cost of the previous asset. So why this is golden rule? Because now we first studied it from the perspective of period of holding that covered 10-12 case scenarios in that period of holding table. Now we are going to revisit this from the point of view of cost of acquisition, where this one rule will apply to more than 20 case scenarios, right? So what is your cost of acquisition of this asset? It is either cost of previous owner or it is cost of previous asset. Now let us read subclause AB. Please.
Yeah, clause AB. In relation to a capital asset, being equity share or shares allotted to a shareholder of a recognized stock exchange in India under a scheme for demutualization or corporatization approved by the Securities and Exchange Board of India, established under Section 3 of the Securities and Exchange Board of India Act 1992, shall be the cost of acquisition of his original membership of the exchange, provided that the cost of an asset, capital asset being trading or clearing rights of the recognized stock exchange acquired by the shareholder who has been allotted equity share or shares under such scheme of demutualization or corporatization shall be deemed to be nil.
Okay. So let me take you to this point. If you remember, we dealt with a list of different scenarios which are not regarded as transfer. And in this list, we had this case scenario where you were member of a stock exchange which was earlier AOP. Now, as member, you were holding two things. One is you are having the membership rights, then only you could be a member. And please understand, what is the relevance of this membership? You could have the rights of trading. Today also, only those share brokers who are registered share brokers, only they can trade. In fact, when you and me wants to trade, we don't trade ourselves. We trade through the brokers. That is where we open the demat account with the broker firm. And we feel that we are trading on the stock exchange. No, they have given you the portal, but whatever transactions you enter into of purchase sale, technically they are rooted in the name of the broker. And that is where the broker charges you the commission. So these brokers who became the members of this stock exchange, which was earlier AOP, they had two assets. One is the membership card, giving them the membership rights, and the second is the card which gave them the trading rights. Now, when this got converted to a stock exchange, in stock exchange, they, in exchange of this, got shares in this stock exchange, and they got a membership, trading card. Now here, when they were having these two rights, they had paid one lump sum amount to become a member. Let us say they had paid 50 lakhs to become a member. And by becoming a member, they were having these two rights. Now, similarly, when this stock exchange was converted to company, which is called as demutualization of stock exchange or corporatization of stock exchange, they got one share and the other trading card. Now, this particular clause says, as per our golden rule, what will be the cost of acquisition of these two assets? They are saying for this, the cost of acquisition is 50 lakhs. That is the cost of becoming member. So the 50 lakhs, which was the cost of membership, will now be treated as cost of acquisition of this shares. Now, since you have allotted the entire 50 lakhs to the shares, hence they are saying what cost we can allot to the trading card or rights. It is nil because we have used the entire cost to represent shares. Because anyways, you cannot separately sell this trading card. It will go alongside the shares. But at least for all practical purposes, since you are having two things in hand, they have given you two costs. One, for the shares of the stock exchange, the cost will be the cost of acquisition of membership in the previous stock exchange. And for the trading card, since entire cost is used towards the shares, rights would be nil. So the cost of equity shares would be the cost of acquisition of becoming member in the old stock exchange, which was AOP. This will be the cost of it would be taken as nil, the cost of trading rights. So this is as per our golden rule 1. Why? Because this conversion and after the conversion in your hands, the exchange is not regarded as transfer. Since it is not transfer, our golden rule applies. For you, the cost of this new asset is cost of old asset. Fine?
Yeah.
Please go ahead.
Clause AC. Subject to the provisions of sub-clauses 1 and 2 of Clause B in relation to a long-term capital asset being an equity share in a company or a unit of a equity-oriented fund or a unit of a business trust referred to in Section 112A acquired before the first day of February 2018.
Sorry to interrupt. We will take this case scenario separately because this is a very specific situation where we will take again an example and we will discuss this point. So for the time being, I'm just skipping this AC because this AC will require understanding of the whole transaction. So let us skip AC for the time being. Then you can read subsection 3.
Yeah, subsection 3. Where the cost for which the previous owner acquired the property cannot be ascertained, the cost of acquisition to the previous owner means the fair market value on the date on which the capital asset became the property of the previous owner.
Now, when this point is applicable, now as per our golden rule, in certain scenarios, you will be taking your cost as the cost of previous owner. We are going to study that section, but this is as per our golden rule. Now, what if you do not know the cost of acquisition of previous owner? Because let us say the previous owner is dead, the previous owner is not traceable. So you do not know what is the actual cost of previous owner. For that, they have given this, you can say a deeming provision, that where you do not know the cost of acquisition of previous owner, we are giving you an option that you can take the fair market value as the cost of acquisition. Right?
Yeah, right.
Now, on similar lines, we have the cost of acquisition of other assets. Other means other than the one which we have studied till now. So now we studied some specific cases, cost of acquisition like intangible assets. Then we studied for conversion of AOP stock exchange into company stock exchange. And then last scenario where the cost of previous owner is not known. Now, other than this, what is the cost of acquisition for all other capital assets? So this is what is given in 55 clause B. Please read.
In relation to any other capital asset, number 1, where the capital asset became the property of the SSE before the first day of April 2001 means the cost of acquisition of the asset to the SSE or the fair market value of the asset on the first day of April 2001 at the option of the SSE.
This is what we call as the 1st April 2001 rule. And why this rule is made, I already explained you above, because indexation starts from 1st April. So for all assets before 1st April 2001, I could not index because I don't have the index rate. So I gave them this option that better you take the FMV on 1st April 2001 as your cost. So automatically what will happen? Your cost will get indexed up to this date. Similarly, clause 2 says that wherever the asset became the property and it is acquired by one of the modes which is not transfer. In such cases, you take the cost of previous owner. And what if your previous owner had acquired the asset before 2001? In such cases, same rule applies. Now, the cost of acquisition for you is cost of previous owner. This is our golden rule. And the previous owner had acquired before 2001. So, the cost will be the actual cost of previous owner or FMV on 1st April 2001, whichever is higher. So answer is simple. Whether it is your cost or it is cost of previous owner, in either case, if the asset is acquired before 1st April 2001, this 1st April 2001 rule is applicable where the cost is higher of the two. Now this rule that you take the cost of higher of the two, one is actual cost and FMV, has one restriction or exception. Please read.
Provided that in case of a capital asset referred to in subclauses 1 and 2 being land or building or both, the fair market value of the such asset on the first day of April 2001 for the purposes of the said subclauses shall not exceed the stamp duty value wherever available of such asset as on the first day of April 2001.
Perfect. So what it says, where you are applying this 1st April 2001 rule, where you are allowed to take higher of the two values, your actual cost and FMV. But if the asset is land or building, there is one capping. The capping is that your fair market value, even if it is higher, you can take that, but it should not exceed the stamp duty value of that land building on 1st April. So it is, you compare fair market value and stamp duty value. If stamp duty value is lower, you'll have to take stamp duty value as your cost of acquisition and not fair market value. So for land building, the capping is that fair market value cannot exceed the stamp duty value. Is this clear to all?
Clear. Clear.
So these are some special cases of cost of acquisition and cost of improvement. Okay. So, cost of acquisition, general rule. It is cost of purchase or construction plus all expenses up to the date of put to use. This is the general rule. Now some special cases. First special case is intangible assets. Two possibilities. If purchased, cost of purchase minus depreciation claimed, if any. If self-generated, nil. So this is the first special case, that is intangible asset. Second special case, asset acquired before 1st April 2001 for land and building and for other assets. For other assets, the answer is simple. It is higher of actual cost of acquisition and FMV on 1st April 2001. For land and building, it is higher of actual cost of acquisition and FMV, but this FMV is subject to stamp duty value on 1st April 2001. So we are talking about cost of acquisition, general rule, and now special cases. Now in this special cases, this is the first, this is the second, third. I'm not writing anything. I'm simply saying golden rule 1, which is here, which is saying cost of acquisition is cost of previous owner, previous asset. This rule will have many case scenarios covered in that one rule. Fine. 4. For rights and for bonus shares, cost is nil. For right shares, it is purchase cost. Fine. So all these are the special provisions that we studied. Now we go to the module where section 49 also gives you cost of acquisition in specified circumstances. Now here I don't have to explain anything. This entire 49 bracket 1 and all other provisions also are mainly talking about the scenario where you acquired the asset in one of those modes which is not transfer. And this is what is covered by my golden rule, that if you have acquired the asset in one of the modes which is not transfer, what is your cost of acquisition? It is cost of previous owner or it is cost of previous asset. This whole point will be covered in majority provisions of 49, especially 49.1 is exclusively for that only. Please read. First read the circumstances and then we'll go to cost of acquisition.
Yeah. Section 49.1, cost to previous owner deemed as cost of acquisition of asset. Where the capital asset became the property of the assessee, number 1, on any distribution of assets on the total or partition of a HUF. Number 2, under a gift or will by an individual or HUF by any person up to 31st March 2024. by succession, inheritance, or devolution. Fourth, on any distribution of assets on the liquidation of a company. Fifth, under a transfer to revocable or an irrevocable trust. Sixth, under any transfer of capital asset by a holding company to its wholly owned subsidiary Indian company or a subsidiary company to its 100% holding Indian company referred to in section 47.4 and 47.5 respectively. 7. Under any transfer referred to in section 47.6 of a capital asset by amalgamating company to the amalgamated Indian company in a scheme of amalgamation. 8th, under any transfer referred to in section 47.6a of shares held in an Indian company in a scheme of amalgamation by amalgamating foreign company to the amalgamated foreign company. 9th, under any transfer referred to in section 47.6AA by a banking company to the banking institution in a scheme of amalgamation of the banking company with a banking institution. Under any 10th, under any transfer of a capital asset being a share of a foreign company which derives directly or indirectly its value substantially from the shares of an Indian company held by the amalgamating company to the amalgamated foreign company in a scheme of amalgamation referred to in section 47.6ab. 11th, by any transfer under any transfer referred to in section 47.6b of a capital asset by the demerged company to the resulting Indian company in a scheme of demerger. 12th, by any transfer of a capital asset being shares held in an Indian company by the demerged foreign company to the resulting foreign company in a scheme of demerger referred to in section 47.6c. 13th, by any transfer of a capital asset in a business reorganization under section 47.6ca, the predecessor cooperative bank to the successor cooperative bank. 14th, by any
Let us not
transfer.
waste time. If you just now you realize that all case scenarios what are referred are falling in section 47 various clauses. So basically entire section 47 list has been reproduced, as you can see. Now in all these cases, one thing what is common is, since these are all 47 case scenarios, it means if you have acquired the asset by one of these mediums, then while acquiring the asset, there was no transfer, hence there was no capital gain which was attracted. Now you have got the asset in a no transfer scenario. So as per my golden rule 1, what will be your cost of acquisition in all these scenarios? It will be cost of previous owner. Please read.
While the capital asset became the property of the SSC, 1. On any distribution of assets on the total or
What you are reading? We already read this, no? You have to read this right hand side.
Yeah.
We already read this.
The cost for which the previous owner of the property acquired it.
Simple. So for you, the cost is cost of previous owner. That is the price at which the previous owner acquired the property in all these scenarios, because all these scenarios are the scenarios of not transfer. Read further.
Notes. Cost of improvement. To the cost of acquisition, the cost of improvement to the asset incurred by the previous owner or the SSC owner after 1st April 2001 must be added.
This is what we already studied in the main section 55, that wherever the improvement comes, the improvement only after 2001 would be considered. Perfect. Yeah. Further, period of holding.
Period of holding. It may be noted that section 242A provides that in all such cases for determining the period for which the capital asset is held by the transferee, the period of holding of the asset by the previous owner shall also be considered.
So this was also covered in our golden rule 1, that even in period of holding, the previous owner's period would be included or considered, or in simple words, you'll count the period of holding from the previous owner. Now comes a very interesting point of consideration. I'll first explain you practically so that you'll understand the practical part of it, so that understanding the theory becomes easy. Now we have been discussing all these special case scenarios, as you can now see. Now in this, I will add this case scenario as well. What is this case scenario? So let us say, I will say father purchased building in 2004-5 for rupees 50 lakhs. He gifted the building to his daughter on 15th September 20, let us say 12. And daughter sold the building on 9th July 24, that is before our date, for rupees 3 crore. Now, in such cases, when you are doing computation, our format will be FBC 3 crores. Again, this is ignoring the stamp duty valuation rule for the time being, because that is not my area of interest here. Now comes the most important point. Since the transfer has happened before 27th of July, indexation is applicable. So I will index this. Now for indexing, firstly, what is my cost of acquisition as per our golden rule? And now what we read in 49.1. Since the asset is acquired by gift, for me the cost is cost of previous owner, which is rupees 50 lakhs. So this is what we have concluded. Now for indexing, we'll multiply it by the indexation rate of current year, which if you remember, it is 363. Now the main question, why I am explaining this, and this is what is the theory point which we have to study now. The question is, while dividing, I will divide it by which year's indexation rate. Now, why is this question? Because there are 2 years. One is the previous year when the daughter had acquired the asset. So she got the gift of this building in the year 2012, 15 September. So whether I should take off 1213, the inflation index, or since we have taken the cost of previous owner, I should take the inflation index of previous owner, that is of 4.5. Now you can very well understand from this, there could be a big difference in answer because the base of indexation is changing, whether it will be 1213 indexation or inflation rate, or it is 4.5 indexation rate. What do you think?
So, I know as per that case, Manjula J. Shah, because of that case, it should be the cost indexation from the period the previous owner acquired the asset.
Perfect. You're correct. Now, interestingly, even if you go by logic, if you remember, I explained you what is the logic of indexation. The logic of indexation is if I'm taking a cost which is 50 lakhs of 4.5 and I'm comparing it directly with today's value of 3 crores, it will be insensible because the major difference in both these values is of inflation. So if you remember the logic when I explained today why indexation provision is incorporated in the law is to give relief or adjustment for this inflation effect. Now, if you go by the original logic, the logic requires that you should index this. Now, since you are taking 50 lakhs as the cost, this should be indexed from the year to which this cost applies. This cost applies to the year 4.5. This 50 lakhs is as per the inflation of 4.5, not as per the inflation of 1213 when this was gifted, because at the time of gift, there was no value. It was free. So logically, if you see the provision, the logic of the provision requires that 50 lakhs should be indexed from the year to which this 50 lakhs pertains, that is 4.5. However, if you go by the literal reading of the indexation formula, the language used in the formula has created this scenario, which says that indexation would be done from the date of acquisition by the assessee. Rather, if I have to give you the actual verbatim language, it says from the year in which the assessee first held the asset. Now, who is the assessee now for whom you are doing computation? It is the daughter. And which year the daughter first held the asset? It is 1213. Hence, verbatim, it is 1213. However, as you rightly pointed out, since this was the verbatim, people were forced to follow this. However, somebody tried to explore the logic, and logically, the person found that, boss, it is more appropriate, at least as per logic, to take 4-5. But the language did not support. So this matter was escalated, and when it went to Honorable Mumbai High Court, in this particular matter of Manjula J. Shah, the Honorable High Court has accepted the logic and provided that you should consider the indexation from the previous owner's date and not the assessee's date. However, the problem is the plain reading of the indexation provisions, which I already said is given in section 48, requires you to take the year in which the asset is first held by the assessee. So this is what is the conflict. But today there is only one judgment. There is no other conflicting judgment. And interestingly, now since this judgment is in favor of assessee, the department should have moved the Honorable Supreme Court, but department maybe very sensibly decided not to do that because they feared that if this would become a Supreme Court judgment also, then it would become the law of the land and everybody would get covered. So they smartly decided not to contest, so that now this decision remains confined to a high court. But still, since there is no conflicting or contradicting judgment, the principle says that the judgment of a high court on any central law shall apply across India until and unless there is a conflicting judgment. So you can very well apply this high court's judgment and you can take the indexation from the previous owner's year. That is in my example 3-4 instead of the assessee's year, which is 13-14. Fine. And anyways, now this point will now not be relevant because from 23rd July onwards, if your transfer takes place, as we have been discussing with practical example, now anyways, indexation benefit has been withdrawn. So this entire case and the relevance will go away. But for cases where indexation is applicable or even after this date, wherever you have the option and you are opting for indexation, still this point and this judgment would be relevant. So this is the first scenario, 49.1. Now, what was 49.1? You acquired the asset by any one of the mediums, which is not a transfer. Another medium which is not a transfer is this: conversion by an individual of his separate property into HF property. So your property was individual, you simply merge it with your HF property. So it became HF property. Now there is no capital gain on this. So in this case also, what will be the cost of acquisition for HF? It is the cost at which you had acquired. Similarly, the next scenario is 49.2. Just a second. Now, 49.2. Again, students, it is similar to what we are discussing. It is again our golden rule. What is this? Shares received under the scheme of amalgamation. Again, it is pertaining to what? The scenario that we discussed. I am the shareholder of the old company. I gave away the shares of the old company, and in exchange, I received the shares of the new company. So the old company is amalgamating company, new company is amalgamated company. Now, when I get the shares of this new company, the question is, what will be the cost of acquisition of shares of new company? Golden rule 1. It is the cost of acquisition at which I acquired the shares of old company. So that is what is given. The cost of acquisition to him of shares in the old company shall be taken as cost of acquisition of shares in the new company. Further, this section says this also applies in case of business reorganization of cooperative banks. Again, if you remember, cooperative bank scenario was also not transfer, where the cooperative banks merged, and again the impact was on the shareholder. I gave away the share of old cooperative bank, and in exchange I got the share of new cooperative bank. which was formed after this reorganization. Sorry. Again, for me, the cost of acquisition of shares of new cooperative bank would be the cost of acquisition of shares of old cooperative bank. Again, the next scenario, same. Shares or debentures received during the process of conversion of these bond share debentures. So we all have studied, you originally held bond share debentures which got converted into debentures. So what would be the cost of these debentures? It is the cost of old bonds debentures. Next. Now this is something different. This is not following golden rule because it is not a case of not transfer. This is the point which Sanjay had asked. Okay, what happens when firstly the company gives equity shares or ESOPs to the employee? I already mentioned that in the hands of employee, this income is a taxable income and it is taxed to the employee under the head salaries as perquisites. Now the question is, what is the value taken? The answer is the value taken is the fair market value on the date of allotment of this ESOPs. Now let us say these shares were received by me. I am the employee of Hindustan Lever and I received these shares, let us say in the year 2014-15 as ESOPs. At that time, the fair market value of these shares was rupees 200 per share. Now today, I sell these shares in the market when the market value is 1000 rupees. Now the question is, what will be the cost of acquisition of these shares? The answer is, when I had received these shares, already I paid a tax. Why? Because these shares were considered as my perquisite. Then, at the time of receiving, if I have already paid tax on the asset, then for me, what will be the cost? The cost will be the value which was considered for my valuation to pay tax. Means, in this case, I already said that when I received these shares in 14-15 as ESOP, at that time the fair market value was rupees 200 per share. As per salary provisions under section 17(2), the valuation provided in rule 3 says that the value of such ESOPs would be the fair market value on the date of its allotment. So in 2014-15, my salary income included the value of these shares as my perquisite income, which was valued at rupees 200 per share. Now today when I'm selling the share, what would be my cost of acquisition? Answer is same value. So the value which was at that time considered as my income will be considered as my cost today. Have you understood this point, students?
Yes.
Because why I'm asking, because this point which is given in this becomes my golden rule number 2. Again, where I'm using this terminology golden rule, where you will find that it gets repeated in different multiple provisions. So where some point is getting repeated in multiple provisions, I am giving it the heading of golden rule so that it becomes a common point in mind. So I give you golden rule 2. Now, what is my golden rule 2? Please understand, students. My golden rule 2 deals with a scenario where at the time of acquisition of a capital asset, the assessee was liable to pay income tax. Now, what are the scenarios covered? You have seen the first scenario, but multiple scenarios would be covered. The first scenario is ESOP. So what is my golden rule 2 saying, or when it is applicable? Where at the time of acquisition, see, income arises when you are selling something. But here, income is arising, tax liability is arising at the time of purchasing or acquiring the asset. Like in case of ESOP, when you acquired ESOP, when the company gave you the ESOP, it was taxed in your hands. In such cases, what is the cost of acquisition of such capital asset? Which capital asset which were taxed to you at the time of acquisition? It is the amount considered as income for paying income tax at the time of acquisition. So what was considered as income at the time of acquisition, now obviously it becomes my cost, because while acquiring, that was regarded as the value of that asset for computing my income. So what was regarded as value of that asset for computing my income, obviously that value should be treated as the cost of the asset. The asset for computing income and paying income tax. So the amount which was considered as value of the asset for computing my income, then that obviously should be treated as cost of acquisition. See, if you understand the logic, here we'll just go on adding the scenarios where the same provision continues. Is this clear to you all, students?
Yes, it's clear. If the employee was asked, employee paid some amount, it was not completely free at the time when employee got the ESOP. So perquisite will be reduced by this amount, whatever the employee paid at the time of perquisite.
Correct. So that will be reduced. But still, the value which is considered for computing income is the fair market value. So firstly, fair market value is considered as the value of shares then. Okay, you paid some portion, 10 rupees, 20 rupees, that is deducted because that you have paid. So perquisite income will get reduced by that amount, right? But the
Right,
value
so,
of the asset was 200 rupees.
cost of acquisition would be fair
Good.
market value, or the
You're
after
saying
reducing
something.
the amount
200.
received from the employee.
200 fair
Yeah.
market value.
Okay.
200
Right.
rupees. See,
Right.
it is simple. Understand the logic. This is where I always focus or emphasize on logic. Share was valued at 200 then. What became my income? See, while computing income, you have deduction, set off, so many things. That is not the answer. What was considered as the value should be considered as its cost today. Correct?
Correct.
This is in 49(2)AA. I'll just mention section also for your future reference. Now, again, going back to the same scenarios which fall in Golden Rule 1, a right received in a form by shareholder on conversion of private or unlisted company to LLP. Again, we know this is not regarded as transfer. So, when you converted your private company or LLP, or unlisted public company into LLP, that conversion is not transfer. But at the same time, in the hands of the shareholder, what happened? You gave back the shares of this company which is converted, and in exchange, you receive the membership in LLP. Now, the question is, what will be the cost of acquisition? That is, what is the cost of acquisition of becoming the member or the partner in this LLP? The answer is the cost of acquisition of the capital asset. What is that? Right of a partner in this LLP shall be deemed to be the cost of acquisition of the shares. So you gave away the shares of this company and you got the membership right in this LLP. So the cost of membership right is the cost of acquisition of shares. So if you see this list, in all this list, the scenarios which are covered, you can see from are not regarded as transfer. And in all these cases, you had some original asset, you gave away that asset, in exchange you got another asset, and this exchange was not regarded as transfer. So our golden rule 1 says in all these cases, the cost of this new asset will be the cost of the old asset. I hope this is clear to everyone. Yes, students, understood?
Yeah, clear. Yes.
I'll request that you all please read this list, this whole majorly golden rule 1. So we stop over here today. I'm sure you all are able to technical, but that is why I'm giving you the logics, the background, or the connecting provision of the act wherever it is connected to any other chapter or any other head, so that the linkage and the logic makes the understanding simpler and clear. Is this fine with all? So
Yes, fine, sir.
thank you, students. Thank you very, very much. We connect again. Again, my request, please keep reading the chapter. The chapter has many things. So in order that you can retain the things, it is important that you be in touch. So kindly read, do repetition. The more you are repeating, the more it will be consolidated in your minds. So with this, we conclude. Thank you all.
Thank you, sir. Happy
Thank
Teachers'
you.
Day in advance.
Thank you. Thank you very much. So sweet of you. Thank you. Thank you, Neha. Yes, Chitra. Thank you. Okay, Ashok ji, we can conclude. Good night, Ashok ji. Good night. Thank you.
Thank you, sir.
Thank you.
Recording stopped.